Keep it tuned. Where would you go for the last few minutes of trading? As we're live from the New York Stock Exchange today, Steve Dudash is at IHT, where he's president of wealth management. He joins the craziness now, as does the HighTower partner and managing director, Mike Pequeen. So, Steve, to you first on how we finish and how important that is. Is it important, say, if we sell aggressively into this close? Not that we aren't already down almost 500 points, but how important is it to you, the mindset of the market, if that's even a term, going into the close?
Well, until we get more clarity from the Fed, until we get more clarity on what numbers are real out of China, we just have to assume that this volatility is going to continue. I personally don't believe anything that's coming out of China right now.
Right.
They've been cooking the books for years. They've been faking it for a while now, and now they're the second biggest economy in the world, and they have to sit up at the big boy table and show the real numbers. Japan's down. Yeah. South Korea's down, Australia's down, but yet China's going to do 7% growth. I just don't believe it. So until we get more clarity out of there, and then obviously with the Fed, what's going on, you're going to see volatility, so get used to it for a while. Well, we're getting used to it at this point. There's no other choice, right? The market today is kind of interesting. I just don't think we're going to see that absolute kind of disaster that some had speculated about. No. So I think Ben Willis was right when he came on at the top of our hour in our coverage here, that the last 10 minutes, that note that was going around and say, hey, watch out in the last 10 minutes. I don't think so. For them, it's funny for me to even sit here and say, oh, okay, we're only down 473. I mean, come on. But I was talking about really selling into the close here. Mike Pequeen, your thoughts on things in terms of, I think the point that was made a moment ago, Steve was talking about China, that we don't know where we are. Okay, fine, we don't. And everybody says that it's not 7% growth, but it's really difficult to pinpoint what it really is and how much of an effect it'll have on us.
Yeah, we're all worried about China. We don't know the reality of China, but we do know the reality of the United States. We see strong employment, strong consumer, low energy, low interest rates. We know that what we have here is good. So there's a lot of sectors here in America that I think are being beat up for no reason whatsoever, despite whatever the reality is in China. And we can count on that data here to be pretty accurate. So do you think that biotech should be off 20% from the peak simply because China is a mystery wrapped in a riddle? I don't think so. So I think that we're all forgetting the fundamentals here. The fact is that this is a much needed correction in what is probably still a secular bull market. And the fact that everybody's getting very emotional about it, I think, is a very healthy sign. I like the violence of this move because that probably means that the whole event doesn't last that long. I think it's a classic correction within a bull market, and we should take advantage of it.
Kind of a few interesting points there. The violence of the move is one of them, because some people say, well, this is too quick for me. But your point is that that's actually a better and more healthy because we get it out of the way sooner. Steve, your thoughts on not only that, but on the point Mike is making that Troy made earlier, that there's got to be some price points here where you look and say, you know what? I know everything's down and it may go down more, but I got to buy here. I mean, there's some opportunity, no? Yeah, I mean, if you're sitting on cash right now, it's a great time to jump in. I mean, if you're still holding positions, you probably have to ride it out. But if you're buying in, it's a really nice time to be looking at opportunities. Energy's down really bad. He was just mentioning, though, that we want to get back to the fundamentals. We can't get back to the fundamentals until the Fed becomes clear on where they're at. I want to see them get out of the fake interest rate market. Get back to the fundamentals where we can actually do valuations on what the companies are doing and not what we think the Fed might do based on what they feel our economy's going. Why does it matter so much? I mean, a quarter point in rates. I was asking this yesterday. Why does it matter so much? That we know. Why do we need that clarity at this point, whether it's September, December, whatever it is? I can't wait until we move a quarter point because our economy is big enough and strong enough that a quarter point shouldn't matter at this point. They probably should have done it earlier in the summer. But even the speculation over it, I mean, everybody, over a 25-point move. No, I agree. That's what I'm saying. It's like everybody says that, like the economy can withstand it. I'm almost curious. What's your thoughts on that, Michael? I'm almost curious why we even care if it's September, December. Why does it matter so much, or does it to you?
Well, we manage about $700 million for affluent individual investors, and to be honest with you, we really don't care that much. A quarter point September, a quarter point December. What we care about is valuation levels. I don't think that it matters unless you're trading treasury bonds, and I think that it's just a red herring. I think that people should focus on the fundamentals, and I think in this case, I think an ugly correction is a healthy correction. So right now, my animal spirits are very much alive, and I think that this is the time to really make a shopping list for those stocks that are not impacted by China at all,
okay,
or by
fine.
interest rates at all.
You're getting exactly what you want then. You mentioned biotech, Mike, already, and maybe there's some others, because you are getting a quick correction and an ugly correction. Now, I want to point out that we were down 500 plus. We appeared to have held 1907 on the S&P, 1920 now, or thereabouts. So it's not as ugly in this particular close, albeit one of the worst market days we've seen this year. It's not as ugly as some thought it would be. Where else are you going shopping, Mike, at this point?
Well, I think consumer discretionary starts to make a lot of sense here. It was hard to find a lot of value there, but now you've got prices that have come into line. And look at what we saw in the auto number this morning. Consumers are buying. Consumers have been constrained. They are now shopping. So I think consumer discretionary makes a great deal of sense,
right.
as well as the healthcare sector in general, including biotech.
All right, we're going to ring this bell in a moment. So, Steve and Mike, thanks for helping us out today.